1987. Like any so-called black swan event, it's not just a one-day thing. It's not single days. It's an accumulation of human errors, assumptions, and judgments, and then actions. Some of the similarities, we had a raging bull market then, but then it was a 5-year bull market. You had a government panic. Remember, Treasury Secretary James Baker came out to voice concerns over a plunging stock market. We had surging federal debt. We actually had a surging trade imbalance that Democrats, Dick Gephardt, was taking action on back then. Exaggerations about concerns of the slowing economy, exaggerations about inflation risk, and don't forget, computer trading run amok. Now, there are clear differences. On the morning of October 19, 1987, news that U.S. warships were pounding an Iranian oil platform rattled the markets right out the gate. Also, of course, back then, oil was rallying higher. And let me tell you something. The 30-year Treasury spiked over 10%. None of that's happening right now. The bottom line, it's a sell-off that did not reflect actual fundamentals of the economy back then. It was a series of negative assumptions and panic that was triggered, in my opinion, by computer trading. So I'm not sure where the bottom is right now, but I am very confident. I think this will be short-lived, painful but short. My worst fears is that investors are selling stocks and great companies at losses that eventually will come back and come back very strongly. On that note, I want to bring in UBS Senior Portfolio Manager Jim Lacamp. You know, Jim, I think the similarities are stark. I think the actions are stark. And here's the thing I want to point out most, the notion that the market is efficient. The market was pricing in some sort of cataclysmic event with the economy. We went almost 3 years after that without even a recession.
Charles, you're absolutely right. And I want to point out, too, you brought up the computerized trading. Back then, they called it portfolio insurance. And back then, you hit a certain level, and all of a sudden, these stop-loss orders would kick in from the computers. And it went down and down and down. I remember that day vividly. And when the market closed, we thought we were down somewhere around 300 points. We still had prices coming across the screen for another 2 hours back in 1987. And that's, again, because these computer programs kept triggering these new sell orders. Now, what we have today is these algorithmic trading. They're not using stop losses. They're selling as markets rally. And it's why we have these strong openings and weak closes, but it's computerized trading. To your point about the economy, we're in pretty good shape. I mean, if you look at senior loan officer surveys, they're not saying that credit has squeezed or is tighter at all. Look at consumer spending, best Christmas in 6 years. Wages are up. All of the signs of the economy, if you look at leading and coincident economic indicators, all of them are pointing north. So this isn't like the Asian currency crisis in '97. It's not like the Russian default in 1998. It's not like the pigs countries. I mean, it is like those in that they did not develop into new bear markets. They were temporary concerns that we fought through. Some of these concerns now are going to be temporary. The government shutdown will likely be temporary. We have a new Congress coming into the House on January 3rd.
Right.
We have the Mnuchin comments. I mean, they were well-meaning but poorly placed. That will pass as well. And concerns about the Fed will ultimately ease. Look at the 10-year Treasury. It's down to 277. So the Fed is likely not going to hike into an inverted yield curve. So I think we'll fight through this. How long it takes, usually these things take 2 or 3 months to work through, but we will fight through it.
You know, Jim, now there are some things, though, that I do find worrisome and I don't have an answer for. For instance, Goldman Sachs, the stock coming into the week down 37%. It got hit on Monday. It was down even earlier today. In fact, I think it was a Dow component that started to bring that index lower. And the banks in general, there are things that I don't know. I'm trying to find out, could there be something in there? Could they be doing something? Could it be the CLOs or the new instrument of the moment that could be backfiring and we don't even know it yet?
Well, that's a great question, Charles, because remember, the Federal Reserve Board had no idea about many of the structured investment vehicles and off-balance sheet CLOs, CDOs. They had no idea of how big that shadow banking market is. Are there things going on behind our backs that we don't know? Probably not to that extent because the restrictions are tighter these days. But can there be? Of course. And certainly the market has a way of telling you some things. But again, when you look at what the bank officer surveys are showing, they're not showing that lending is impaired at all right now. In fact, pretty healthy. Most of the economy isn't as robust as it was 6 months ago, but it's still pointing north, and not only that, it's one of the stronger economies in the world. I would say this, too, about the banks. There's a lot of firms calling for the return of value investing over growth investing. And that may happen, but remember, 25% of that value index is the banks. Another 12% are the energy stocks. So until we start to see those move, that may take a while to develop a new theme on Wall Street. And Wall Street likes themes that they can chase. Right now, we're having a hard time. We have a shambolic presidency in many people's eyes. We have a Fed that's too punitive in many people's eyes. So it's hard to develop themes right now, but values are starting to present themselves in terms of PE ratios, et cetera. I think corporate earnings are going to be fairly healthy as well.
Yeah, I mean, I'm not sure if I should say this and what it really means, but one of the security guards who never spoke to me before called me over a moment before